Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about closed-end funds and our investment strategy on investing in the market at large. So this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I am a financial strategist, and I don't speak like the herd. I walk in a limited company, and sometimes I walk alone. So I don't have any notes for the week. I mean, I have a rough outline, just a really rough outline of the intro, and then I don't have any notes from here. So there's stuff that I do want to talk about. Uh, it was reported the CPI data would come out this past week, but it didn't. It's due to come out this upcoming week. Most everybody thinks the Federal Reserve is going to leave rates where they are. Um, with Yeah, the Federal Reserve it is its own thing. We're not pushing that anywhere anytime soon. So with rates the same, you and I both know that inflation is sticking around. If it goes up, it's just more proof the Federal Reserve is quietly printing money. Because if, giant if they're really controlling rates, more like manipulating rates, but if they're controlling rates and the monetary policy is controlling rates and we're increasing inflation, the only reason we would have more money in the environment is if they're printing money. So the if we can't section the Fed out, but if we can kind of put them off to the side, what everybody has confirmed for the week, what everybody across the board has confirmed for the week, is that nobody knows how the economy is going to go, or at least nobody knows the general investing landscape that's going to unfold as Trump 2.0 continues to roll out. He's had a busy week, busier than Biden's been in the last 4 years. Uh, we have tariffs between Canada and currently Colombia, maybe Mexico, maybe China, maybe a lot of others. You have Trump floating no IRS, like no income tax. That would be a huge thing for us because I don't want the federal government taking money out of my pocket any more than you do. And if you think we need the federal government taking money out of our pockets, then you should go back to high school or at least go back to school and look at how much that really benefits everybody. Uh, about 100 years ago, the U.S. didn't have, say, prior to 1913, the U.S. didn't do income tax. It relied on tariffs to pay all the bills and fund everything else. And then in 1913, we switched that to letting the people carry the burden for all of that stuff. So I would much rather go to a tariff system and get more money back in my pocket. I also have a problem paying the federal government more than God because that, regardless of political system, regardless of what political or religious system you're a part of, when my tithing is 10% to God because he's God, and the federal government says, well, you have to pay me 22, 26, 30, whatever it is, okay, they're elevating government above God and elevating government's importance above God, and I have a problem with that. So I would much rather pay nothing to government and nothing to government and put God back where he belongs in what we're giving him. The hierarchy matters to me. So let's see, off topic, but on topic, yeah. So if we stick the Fed to the side, we stick Trump's tariffs plan to the side. No one really knows what's going on. So we have all of these different ideas and conjectures, and it's really pushing fear into the market overall. Like 2 weeks ago, we were in extreme fear. A week ago, inauguration week, we're at kind of fear. And now we're at neutral just based on CNN's graph. And it's a general market sentiment, but it's not accurate per sector. And it's really not accurate overall. There's a giant amount of uncertainty on how things are going. The economy seems to be strong and just chugging along. It's the Fed's holding a lot of that back. Uh, you have tariffs coming in. You've got RFK Jr. hopefully coming into health and human services, which will impact commodities and U.S. consumer. we'll say the U.S. consumer market, whether that's General Mills or Kellogg or Kraft Heinz or even the pharmaceutical companies, you you've got tariffs potentially impacting foreign countries that want to get their goods into the U.S. You have this uh, reinvigorated push for everything made in America, so it's really going to shake up the market overall. If we look at where the market is now, it's still very much a bond market. So we look at bond market, we look at overall dividends, who can pay the dividends, who's likely to have a raising dividend or an increasing dividend. You look at maybe preferred dividends, depending on your stance on that. You look at bond proxies like utilities and energy, even housing to a degree. You have this huge, huge push for AI with the Trump announcement, but also just the current market. You have this huge push within technology. But in that, you also have to have oil and supply in order for that to happen. So no technology, if we don't have an oil supply, the technology advancement and AI development doesn't happen because all those microchips are made out of oil. So you have this uh, I don't want to say can of worms, but we're kind of blowing the lid off things. So we grant everybody back the ability to drill. So you have a resurgence of oil. There's speculation, a lot of skepticism, but there's speculation on how that impacts the oil market and the energy transfer market. We have this resurgence in oil, which will then feed into AI. And then with that, and how people manage their storage and cool their storage, there's been a increase of cost in cold water storage. You get a lot of companies switch to natural gas. So there'll be a push for oil, there'll be a push for more natural gas, there'll be a push on utilities. So depending on your stance of where you want to invest, from my stance of things, oil isn't, you would figure oil would be cheap in the sense that we're about to like open the trough again and allow a lot of other things to happen. But currently, oil isn't that cheap comparatively. It's not high in discount compared to everything else. It's still a bond market, which would still be an energy transfer market, which would still be a like a utility market. Uh, let's see, bonds, utilities, overall energy transfer. Uh, and it's weird separating energy because it's hard for me to envision energy outside of oil because oil really does steer everything else. So we have more oil coming in, but it's not quite on sale, I guess you could say, discount wise, of where I would prefer it would be for us to buy it. Uh, but with bonds, still in kind of optimal sale, but at the same time, not like all the discounts are gone, but the discount game has changed. It's almost like the discounts are closing in ways. Like we have to be even more selective in what we're picking. Um, and then as that overall CNN pendulum happens, like between crazy fear and crazy greed. If you're going to buy in crazy greed, that's fine. I would highly encourage you to demand a discount versus when we're in crazy fear, it's really easy to find a discount because everybody's selling their stuff afraid. So we're in the middle. It's hit and miss on what you can find. Um, and honestly, like closed end fund wise, for the and I'll go through things, but on the Roth side of things, there's a clear cut winner. Like there's an easy first pick, there's an easy second pick, and then after that, I mean, I could argue for all the funds. For the individual fund or the general brokerage fund we have, we're not adding to it. Uh, but on the flip, we are building a new portfolio because good news for us, we did move our funding outside of our previous uh, advisor advisor services. There we go. We hit a point where with our former advisor where we realized we couldn't wait. to make a decision any longer. It had been stuck in limbo for a while. Our investment strategies were very different. Our overall goals were very different. Um, it's extremely hard for me to track overall return of investment month to month, year over year, to where in the end, the only like the best data I had was what I could see on screen. It wasn't the best data that anybody wanted. Um, it's that weird argument of, your portfolio has, and we didn't argue, it was just like we did it. But the argument is your portfolio's gone up in value. Yeah, but comparatively, like if you take the value divided by the total number of years we've been with you, that's really not that much growth every year. So it's worth more, but it's not, I mean, less than 3% is not even scraping to break even with inflation. So most brokerage firms or most brokerage advisors look at growth of capital or say the growth of the value of your account, not so much the dividends you're earning. So less than 3% growth averaged over years with less than 2 grand in dividends. I mean, the market overall has gained in the last year, but not everything has gained in the last year. It's an average for a reason. So our strategy to grow our overall return, grow our capital, um, knowing that the market's going to do this, and we don't want to reverse dollar cost average our buys and gradually sell off our principals. So as the market does this, we want consistent dividends to where we can either supplement or live off those dividends. So as the market does this, right, or ideally we all want it to go up, right? But as the market bounces back and forth, we don't want to sell our principal to generate income when we retire. We want that principal overall to go up, right? Like everybody does. But we know the market's going to bounce. And as it bounces, we still want we want reliable, uh, it'll mean really 9%, but at least 8%, 9% dividends that are steady monthly payers. I mean, now maybe we'll have one or two outliers that pay quarterly, but really we want consistent monthly dividends and stuff that will either maintain about like stuff that will either, or say funds that will either maintain the dividend or that will grow that dividend, right? Because we would all like to buy at a price and have the dividend grow. You get a better overall return of investment, better overall dividend yield, all of the above, right? So we're looking at how to use the best market or how to use the market right now to the best of our abilities long term. And some stuff we'll swing trade it, meaning we'll let it go up 15, 20%. We'll sell it and we'll swing the money forward or carry the money forward into other pickups as we go. The other stuff we'll buy and hold, and we'll either, um, I mean, we have the option. You can either sell it high or ride it out and then buy it low again, or you can keep it and weather the roller coaster and buy it low, right? So you get a better overall dollar cost average. It really just depends on how you want to play the market. It honestly, it depends on your overall strategy. So of the tabs that I have up, um, let's see what I can get rid of. Of the tabs that I have up, I wanted to show you one, the closed-end fund master and how it sorts out. Uh, what what would be the for sure top two for the Roth, but we're not buying in the Roth tomorrow. And what the current target list, which I'm still picking through, but what the current thought process is on the first round of investment from what we recently transferred, plus two funds in particular on that list. So let me share my screen. Let's see. So here's the tab for this week's closed-end fund, I guess, hit list, I guess you could say, or maybe find pick list. But of the overall master, the master got updated early this morning. Um, and see everything in purple, light blue, dark blue, and green gets updated weekly. Everything else I update monthly. And then I rank it out based on targets, which outside of three funds, I found three exceptions to the rule, which I'll get into. Um, Three asterisks is a buy alert, which is normally double the historical and greater than the 5 year average discount, unless it's a newer fund. I mean, there's leeway for funds that have not been around as long. Um, and then I found three exceptions to the rule, but then otherwise there's two asterisks, which would be funds we own that would be a dollar cost average alert, meaning it's a better price right now than our average. And then a one asterisk is just we're tracking for any number of reasons. So if we come to the list for the week, and they're currently all listed by discount, you'll notice two funds at the bottom and then ADX towards the top. And I will hover over these for a second. So I mean, I can read it to you. I'd rather not, but that way maybe you could pause the video and read it yourself. And then we have this one down here, which I'm going to have to add like 40 at the end in order to get a better view. So we have DNP, which is a utility fund, then PDO, which is a bond fund. It's a relatively new bond fund, but it's a bond fund by PIMCO. And it's just very rarely in discount land. Like it started out that way based on when they started in the market overall, but um, it it's hard to buy. It's hard to buy a true discount when it's always premium. And for a guy who has preached buy the discount, don't buy premium, it I get it. It's very weird for me to say it this way, but it's DNP is always in premium territory. So you're never going to catch a discount. Maybe on a fluke, like the right scenario, the right day, the day you're logged in your account, maybe it's the right scenario. But it's really never going to drop below zero or break even. So you're better off trying to find it when it's below the overall 1 year average. So the 1 year average is +8, which means instead of say for every dollar you're investing, it costs a dollar, break even. Or we're at the top, like for HFRO, for every dollar you're investing, you're getting 56% off. That's really like 44 cents for every dollar invested. So on the flip side, 8 plus or +8 is $1.08 for every dollar invested. So if the year average is $1.08 and the current cost is $1.04, even though it's not a discount, you're still getting it at a discount relative to what it's worth. Um, let's see, PDO is the same idea, except you can control or you can decide how relative to or how close to the average you want. It's not really going to be in discount territory, so or say true discount, like negative discount territory. So when it hovers or it drops below the existing discount level or the average discount level, then that would be the optimum time to buy. So is 521 close to 419? Yeah, it's a cent off. It's like paying $1.05 instead of $1.04. But if you wanted to wait until it was under $1.04, then that's up to you. The other exception is this one, and it's one I have up top. But ADX is always in discount mode. Um, it's a hidden fund in the sense of it generally pays a measly dividend, like a 5 cent quarterly dividend, and then it pays a special dividend at the end of the year. But they changed that recently. Like you really wouldn't know it by this graph. You really wouldn't know it by this existing distribution rate. But normally you're adding, so 5 cents, 5 cents. This number would be 5 cents, and then this year end number would be whatever it is. Adding those four together and then dividing by the current price, and then you get your actual dividend yield. Currently, the price is based on these, right? But the next dividend payment will change the game because the next dividend payment will get averaged between 5 cents and at least three. And then you'll have your new dividend rate, which currently, if I go back to the list, let's see, ADX. So the current dividend is 11 and three quarters. What once it recalculates at the next dividend payment, then it jumps up into 13%. And as to what's in the fund, come on, you can get a top 10 on closed-end fund or CEF Connect, but Morningstar's got the top 25 of all its portfolio. And you can argue for and against this. I mean, it's heavily invested in tech. It's all stocks. And based on their breakdown, it's a true portfolio in a can with investments in every sector. But at the same time, everything is technology driven. So, regardless of where you're going, everything is AI based, everything is technology driven. And you can argue for and against overweighting the portfolio. Like instead of having everything at 2% or even 3% down, they're heavy weighted in Apple, Microsoft, and Nvidia, even Amazon. I mean, you can argue for and against that. The only It's more like a whisper. Not everybody's saying it, but there's this growing, not even fear yet, but there's this growing idea that at some point this year, and no one wants to stick a nail on it, but some point this year there'll be a anywhere between a hiccup and a major market correction that would be. I've seen one group say it would be a 10% drop in overall market because of any number of things, the Fed corrections, the Fed manipulation, that outpacing of technology and AI overall. There's general fear, but everybody's pouring money into AI. So at some point, there's going to have to be some type of tech bubble. And not everybody's saying it, but it's out there. So my advice is regardless of how you're investing, uh, and my my check rate almost for myself is as confident as I am or as excited as I am, it's not like I want to be fearful and let the fear guide me or limit me at what I'm doing. I just want to be aware of things because it's very tempted. Like it would be if you had 10 grand to invest in any number of things or 20 grand to invest in any number of things. It's very tempting to even if you uh, laser focus on maybe three or four funds you can invest in, it would be very tempting to put all of that into the market at the same time. And you could be super confident based upon the current market, but I would still tell you to spread out your investment over at least a couple months. You get a better dollar cost average, and you could argue, be like, yes, it's current price. The next month it's $3 higher, right? But maybe it doesn't fit the discount metric anymore, or maybe there's a better deal on the market that you didn't think would appear. It's you have to look beyond the fear of missing out, and you have to look beyond that it's I can't explain it. It's like you have to look beyond your own self-confidence. It's you feel good about what you're doing, but at the same time you have to check rein yourself. And if you're going to invest ten grand all at once, great. But if that's like if you're not going to add 10 grand or 5 grand or 3 grand or $100 the month after, my advice would be to split your money or divide your money and spread it out over a little bit longer. Because if the market did drop, so you say you drop 20 grand in the market tomorrow, and then the market takes a 10% hit and you have nothing else to invest. When the market, I won't say when, so if the market drops the 10%, you know as well as I do, the herd group is going to run scared and there's going to be initial sell off. The market will tank overall. Fear will come back. Maybe even extreme fear will come back, even if it only lasts 2 days, right? But after that initial, or say, whether it's a bubble pop or we hit the next little dip in the journey, when that happens, you want to have something on hand so you can buy because it's challenging to buy when it's neutral. You have to be extremely like highly selective when it's in greed territory. Like it's tempting to buy in greed because everybody else is buying. Like you don't want to miss the boat. In neutral, you've got to really know your strategy so you know you're getting the best deal. But the best, absolute, amazing time to buy is when the market is in fear or even extreme fear because you get the biggest discount and you get the discount by itself is sometimes misleading, right? Some of those are 2% discount doesn't seem like a lot, but it is in comparison for the fund versus 56% seems like a lot. And it is. And it's been that way for a while. I think those fears are oversold. So, or overblown, I think there's way too much fear than there ought to be. So the discount by itself is important, but it's not the only thing. If we saw a 10% hit to the market, this discount would pretty much remain the same, to be honest, because this discount never really goes away. So this discount might increase a little bit, but it's not going to get 56% wide. So we'll have a similar discount, but the price will drop $2 at 10%. The price would drop $2. The overall NAV may or may not drop by the same amount. The discount would be relatively the same, but now it's suddenly cheaper to buy the same fund. So if you go all in on this month and then it drops 10%, and now you can't pick up the next batch, it doesn't really help you. So losing 10%, right? So like if you started at 20, that's an easy number. So if you lose 10%, you lose $2. Now you have 18. Well, if the market gains 10% back, you're not closing that $2 loss. It's 10% from 18. So it's really it's $1.80. So you're now at 19.10 and not $20. So you've lost 10% and gained 10% back, but it's based on different numbers. So as tempting as it is to go all in, if that's your strategy, great. Just know it and be able to defend it. But my advice would be to spread it out over a little bit longer. So of the Roth, of what we're doing, there are two clear-cut winners. And I could go through the normal spiel of things, but if you've watched these videos, you've seen me go through the normal spiel of things for a while. Um, for the Roth, we're going to target monthly payers, and we are going to hyper focus on the best deals for this current market. So the absolute best deals, even though the discount has closed considerably, is still FCO or FSCO, an all-American bond company with a giant amount of total assets, a company who looks like they're about to sell some common shares to generate more capital where they can then invest or lend it out. Plus, they're a private BDC or a private lender, which is great for the small business environment coming into Trump 2.0. And they recently raised their dividend. Their price has not spiked, but their price has gone up and their discount is closed. And honestly, if it went to premium, I would change that triple asterisk of the three exceptions to the rule. It'd be a fourth exception to the rule. FCO, it would be my top choice above everything else. So I mean, you get premium bonds, utility, covered call, or they excuse me, they I mean they pad their dividend. You get preferred yields, mostly bonds, municipal. Outside of ADX and NBXG, I'm not tempted to buy other stock funds at the moment, so that would eliminate here. It's a great corporate bond fund. It's a high fixed income percentage. It's like on the pendulum of total assets, where FCO is, that's on one side, where CIF is, it's on the other. But FCO wins that battle because they're a private lender business development company. You've got more bond options, but it's still doesn't really outpace the group. Municipal doesn't help in a Roth. We're already invested in bonds. It's got to be better than what we already have in order to add more. Municipal bonds, same thing, doesn't help. We already own BRW. Tempting, but not as good as an overall position right now as FSCO. Saba used to be government bonds. They've changed that portfolio a lot. Maybe 25% foreign investments right now. ERH used to be, it's a little confusing. So it's the same ticker, but it used to be managed by a different fund. And I'm not a huge Allspring fan. Still, I mean, it's a global fund. You'll get more swings, but yeah, I mean, besides NVXG and ADX, I'm not looking at other pure stock funds at the moment. TEEF is probably better termed a utility fund, uh, but it is a term fund. It's the weirdest fund to me. I mean, it's heavily based in renewable energy and no oil, and yet at the same time, all of their product requires oil in order to work. Um, BRW actually owns TEEF. Unless the price dropped out. I mean, I'd rather own TEEF in BRW than own TEEF outright. HGLB is kind of like a portfolio in a can. Um, it's got a lot of what we're targeting at the moment, and I could vouch. I mean, I could argue for it, but it's just not as great a deal as FSCO or HFRO. HFRO remains the largest discount, and I think those fears are oversold or overblown or however you want to say that. They're making their payments. More square footage is coming online. They're managed overall by the same Highland, right? Highland funds. HOB just raised their dividend. HFRO went from a like a bond hedge fund and then transferred everything into real estate, which you could argue for and you can argue against, but they went head over heels into real estate. And that was a huge switch from their head over heels into bonds. And they didn't really explain that. People were kind of questioning that. I mean, I would. So, having never really explained the reason, just touting the new portfolio, as more square footage comes online, they should do well. Yeah, so I could argue for all of them, but the best of the list is this. So if we were investing in the Roth tomorrow, we would buy one of those two things, or both if we had the capital for it, but we don't. The Roth, we've been playing the waiting game to see how the individual portfolio would go. The goal is to max the 2024 contribution and then start the 25 contribution. So, I mean, the goal has been to watch these two funds in pink. KYN and ML are oil and gas, energy transfer, IGR is real estate. DSL's it's a fund bond company. Um, so we'll see how this portfolio goes. And I wouldn't be opposed to merging this portfolio into what we're building. So this is part of what we transferred over, and this is my initial thought process. Um, I'm trying to be I'm trying to be especially selective, or however you want to say that, highly selective in what we invest in. And if I'm going to be extremely particular, I mean, there's a list of funds that I've listed on the Roth. There's a list of funds that I would love to house inside a portfolio and have all of it there, whether at one time or just kind of rotating in based on cycle. And you can make your argument and strategy for either. But it's a current bond market. So these are, I mean, there's municipal, right? The PDO. If I'm going to try to be hyper selective, however you want to say that, 1 cent is close. It's super close. Um, so it's really on the fence. But this is what I have right now. So if I'm buying tomorrow, and we are buying, how much of this we buy, we'll see. But we will not be buying the full amount. We will spread it out over time. So real estate. So we're playing the same game, but at the same time, we're playing the same game with different money. Uh, we will concentrate on the current market. It's still a bond market and a bond proxy market. You can argue for oil and tech because it's needed for technology and AI growth. You can argue for it, and you can argue for it for all of these things. You'll need oil for this, you'll need oil for that. Completely true. But if we look at where we are right now, my two favorite oil and energy transfer funds don't fit the metric. KYN, there we go, over here. Historically has a premium, there's no discount, right? And that 5 year discount sits around 14%. And then we have NML, which is similar, right? Now, the 5 year discount, yeah, I mean, I don't think we're going to hit 18% just based on age of fund and everything else, but it still doesn't fit the metric right now. Um, so, in looking past here and targeting these three and staying away from the general consumer stocks outside of funds that have proven history, and ADX is this. So we have this overall, which is not quite just a dividend game. It's not just like an outright greed cycle. Let's see. I'm just looking at overall growth. So COVID is this one here. Um, that looks like the housing bubble right there. So, I mean, over time, yes, they're up. But since COVID, they're up crazy. Distributions, so it's generally the 5 cents per quarter with the special dividend at the end, but something changed recently. And I'm curious if these other dividends will change over time as well. Pricing information, the discount never really closes, but overall fund value goes up and they pay dividends. We can close this stuff. There we are. So of what we've already discussed, so HFRO, HCLB, BRW, FCO, NBXG, for all the reasons already said. DNP is a utility fund, right, that really never hits break even. I've chatted about that already, right? So it says it's 4% premium, but based on its track history, it's actually selling for a discount right now. ADX, we just talked about. PDT meets the metric, and it beats its market benchmark competitor, but it's also built on preferreds. So in an odd rate market, that's kind of nice. Um, so if we look at this one overall, like I get the current distribution rate, but what I wanted to show you was this. So if we look at when Trump was in office the last time, you have a much different dividend outlook than we have right now. I mean, in general, the dividend was higher. but they also paid special dividends. Pricing wise, you had some premium, say during Trump 1.0, it was in premium for a while. As to what they own, it's kind of portfolio in a can-ish, but it's not really because it's overweighted in certain areas. Utilities, energy, right? What we're looking in. Communication services is, and you could be invested in AT&T and T and say you've got oh look, and say you have communication services, but that's really just technology. So just because, I mean, Philip Morris, see Dominion Energy, National Grid, Southern Company, Crown Castle's a cell phone data company. I mean, they all have their sectors, but at the same time, it's really a huge investment in technology. Just a different way to play that game. So outside of that, it's municipal bonds. Now, I could make a case for everything below, but I'm still trying to somewhat honor my system. I mean, I've made video after video after video about demanding a discount. So I'm not going to pay a premium on OXLC because it does dip into discount. And for these, it doesn't meet the metric. Um, 2 weeks ago, it had a wider discount and it met the metric. So I'm not going to slack on that. PDO's one of the three exceptions. But I mean, yes, you can argue it's a cent, but I don't know. Everything I add to the list just takes further away. So this is what I'm thinking about. And I've got tonight, I've got tomorrow morning for a little bit, and we'll see how it plays out. But yes, regardless of what that number is, we're not going to invest it all in one go. That seems very foolhardy to me. Uh, we want to make the best ultimate decision and make the really hard decisions. And part of that is if it's like if you're second guessing your investment, it's probably not, if you have to convince yourself to do it, it's probably not a great idea to do it. Um, we want to get the best overall deal we possibly can in this market for the long term. Uh, we want to spread out the investment over time. We want to, yes, be able to increase our overall dividends period. We want to increase our annual dividend. Um, to be quite honest, of how we were invested previous, we had more money than this invested, and we had just about that in annual dividends, and not much overall return of investment. So that's kind of like it's really tempting to just be like, look, completely different strategy. Look at this, but there's got to be a check rein. Can't do it all at once. Can't. So to review, because I can chat longer. So to review, if we were buying in the Roth, we would pick these two, and it would be this one over that one. Despite that one having the greater discount, this is the best deal in this market, and a close second would be this one. In the individual brokerage right now, not buying. The portfolio, we're going to redo, take on more responsibility, however you want to say that, more responsibility, uh, and invest that. And then what I would do short and long run, um, if possible, is to transfer this brokerage account to the other company to have it all under the same umbrella. That would make it easier. I mean, you would think it. So currently, this one and this one exist in the same uh, brokerage, but because it's a Roth, I mean, what's in the Roth is in the Roth. But so the individual brokerage, I have to sell it, move it to my bank account, and then put it in the Roth. It's not like I can just sell it and transfer the money over. So Either way, my bank ends up being a holding account for funds either way. So I don't know. Long term, maybe we would combine portfolios. Maybe even we would move the Roth over. I like Webull, but I also like having everything in the same place to make it easier to manage. It's easier for me, but if I really think big picture, what if, while it's easy, while it's easy for me to do it, if something happens to me and my family has to take this on, then I really want to make it as easy as possible for them to manage. And having multiple accounts spread out doesn't really help them have the easiest time of things. So, bigger ideas for me to think about in the future. But as for this, that's really all I got. Um, if I'm going Roth, it's FCO followed by HFRO. And as to establish a new portfolio and think bigger picture of current market and coming market and how I think the years will unfold, it's that list on the page. Part of what we already own, part of what we don't own. Um, and bubble or not, 10% blip or not, I'm I would be willing to invest in ADX and NBXG, two different companies. ADX has been around for a while. NBXG is relatively new. Both stocks only companies. They're not in bonds. Both heavily invested in tech and AI. Um, and you can argue for other sectors of what they're invested in. Somewhat lost my train of thought, but I'd be willing to invest into those companies, uh, knowing their track records. And despite NBXG not being around for that long, it does have a decent track record. But knowing their company's overall experience and record and stuff, I would invest in that. And quite honestly, if we had a 10% blip or a 20% blip, which nobody wants, then we would still be decently positioned to buy more. That's the hard part with the Roth is it's a set investment. Like you can only put in X amount for a year. So if you've already put in X amount for the year, you're really riding the roller coaster of things. But the advantage to the Roth is so long as it's done inside the account and you don't take money out of the account, it's all tax free. So on the Roth, it's all post tax money going in. You conduct business inside the account. You wait until after your, I think it's like 59 and a half. You wait, you jump through all the hoops. You wait until the end. You could take everything out of the account first day and it would not be a tax penalty for you. So long as you're willing to play the game, it's tax-free money. It is not like the rest where it's tax deferred. It's just tax-free. So as roller coaster as it could be at times, I'm willing to ride the roller coaster for that tax-free scenario. Um, let's see, but that's really all I got. So to rehash, individual, not right now at Webull. Roth at Webull, not right now. But if we did, it would be FCO and HFRO. And for the new fund, which I don't really have a name for that yet, but for the new fund at Fidelity, maybe it'll just be Fidelity. But for the new fund, we have that target list, and then we will see how the morning plays out. So whatever y'all are up to, I hope it goes well. Whatever you have for the week, I hope it goes well. We are almost officially one full month into the year. We are one full week into President Trump's 2.0 journey, and we will see how the rest of it plays out. The financial data for the week should be interesting. The inflation numbers for the week should be interesting. Um, yeah, we'll see what the Fed does. And regardless of how the market goes, the best advice really is scoop the best deal possible in this environment for the long run. Don't pay attention to fear of missing out. Don't pay attention to buy this today so you can sell it for 10% tomorrow. None of that. It's buy the best deal for now for the long run. So whatever you have for the week, I hope it goes well. I will see y'all in another video. Bye-bye.